Hello, hello. Hey, everyone. Welcome to our latest Gate Pass Market Pulse. This is a series where we sit down with thought leaders from the investment landscape and really try to just sift through a lot of the noise and recap what happened in the first half of the year, but really also take just a cleared eye approach as we head into the second half of the year as well. So today, I'm thrilled to be joined by Chris Galipeau, who is the senior market strategist at Franklin Templeton. If you're not familiar with Franklin Templeton, they're a huge global investment manager, overseeing about $1.5 trillion, been around over 75 years, served clients in 155 countries. So they've been very well established both on the equity and income side of things. Chris specifically brings over a decade of experience in the capital markets, having served in senior roles both at Putnam and DG Capital Management. And in 2002, CNN Money ranked Chris as the top equity research provider in the country. At Franklin Templeton specifically, Chris works across their autonomous investment teams to really synthesize both their macro and market views and really just deliver timely insights both to their clients and advisors. He's a member of the CFA Society of Boston and the Market Technicians Association as well. But most importantly, Chris has an incredible way of just making these complex macro trends very digestible and actionable for clients. That's why we asked him to join today in a Q&A format to really just share their perspective on where we've been and where we may be heading and really what matters most to the markets right now. So with no further ado, Chris, thanks for being here today.
Dave, thanks for having me. And by the way, I want to say thanks for calling out 10 years of experience, because if I really only had 10, I'd be a hell of a lot younger than I am right now.
Right, absolutely. No, we're excited to have you join here, and you look no older than 30, so I appreciate it.
I knew I loved you, Dave.
No, awesome. But I think it would be good for our clients really to start broadly and then kind of go down the funnel, right? And I think top of mind right now for clients are interest rates and the Federal Reserve, right, Chris? And so we obviously have the Federal Reserve meeting coming up at the end of the month. Obviously, it looks like the market expectations right now are for the Federal Reserve to potentially cut in September, but curious on what's your thoughts right now with the Federal Reserve, where their next move may be, and also what could occur for them to continue to pause and keep rates where they are.
Okay. So the present stance is in the pause mode, as you referenced, right? And what Powell has said, and remind everybody, it's not just one guy that makes the decision, it's the entire board of governors that has to agree generally. What they have told the market for the better part of the last 6 months, certainly in the last 3 or 4 months, is they want to wait and see what impact the tariff program has on inflation. And so that makes sense. That's pretty straightforward. The rules are not final yet. The goalposts keep moving. Now we've got it out to August 1, so I have no idea if that's going to stick or not. There's a lot of things to consider here, right? Number one, if we look back at Trump 1.0, let's call it, and then he used tariffs in the first 4 years as well. If you look at the impact of tariffs on core inflation, there was none. Right. Now, the tariff rates today are much higher, at least in theory, than they were then. And so it's reasonable to think that there will be some impact. We think that there will be some impact, and that the tariffs, wherever they end up falling, could and will put some pressure on companies to make decisions here. Do we pass the costs on, which would raise prices, that is what inflation is. Some companies will have to, some companies won't. Some companies will have to raise prices on a few things. So Powell's waiting for that all to get sorted out. I think if we didn't have to contend with the tariff program, they would have already either communicated that they're too tight, which they are, or already cut rates, right? So our view is we get the final rules. They look for a little more data through probably the month of August, and then maybe they're ready to move in September. He's already said, we don't think this is a long-term inflationary problem. We think it's, use the word transitory again, which is kind of surprising, but they think it's going to be near term in nature. We happen to agree with that stance. We think they're likely to cut rates in the back half of the year. What does that mean? Well, when they cut rates, you have to ask yourself, why are they doing it? So usually when they're cutting rates, they're doing it to encourage risk taking. So they're lowering the cost of borrowing, and they're encouraging people to take money out of a savings account or checking account or whatever and start a business or buy things, right? To stimulate economic activity, stimulate the economy. That's the first thing. It is very rare for them to actually cut rates when the economy is expanding, which it is now. So they did that in 24. They've now hit the pause button. They're now likely to reboot and start to cut rates again. That's good. That's good news in terms of it's accretive to the economy, therefore likely to be accretive to earnings, but there's a big lag, right? So I wouldn't expect anything material to happen if they do cut rates. The stock market will move around on that. The bond market will move around on that. But out 12 months, 14 months, it's usually pretty good news. And especially when they're cutting in an economy that's already resilient and growing, and that is the case today. So.
Right. No, that's a great. And if we just double click on that for a second, I mean, what do you think as rates come down? I mean, from the consumer standpoint, right? For the retail investor, I mean, how do you view cash versus fixed income, and then maybe specifically around mortgage rates too? Do you have any specific thoughts around that?
All right. So the Fed lowers rates, money market yields will reflect that immediately, right? So they'll step it down by, let's say, 25 basis points.
Right.
The rest of the yield curve probably adjusts as well. I think and still think that shorter duration fixed income exposure, right? So not taking a lot of rate risk in client portfolios, meaning the returns are subject to the swings in longer term interest rates. I think you can capture, mid four handle yields in mandates that are one step away from money market funds that won't adjust and won't be impacted immediately by a rate cut. With de minimis rate risk there, I think that's a great spot, one guy's humble opinion, but a great spot to sit and wait. The rest of the yield curve would be interesting to see what happens here. And with your question on mortgage rates, I get this, Dave, I get this question every day. We need the Fed to cut rates to bring mortgage rates down.
Right.
Well, the base assumption in the question is that by cutting rates, mortgage rates will come down. I would not assume that at all, right? Mortgage rates are generally you can proxy them by 10-year yields. And if the Fed is cutting rates, they're trying to stimulate growth. And in an economy that's already growing, I wouldn't expect 10-year yields to come down, if at all. I would expect them to stay in this 4 to 4.5 range. And if the economy improves, what should long bond yields do? They should go up over time. The only time that long bond yields respond by coming down, right? Bond prices up, bond yields down, is when the Fed is cutting rates because we're headed into recession or are already there, meaning they've already broken it and they need to try and fix it quickly and bond yields decline. That's not where we are.
Right. No, that makes a lot of sense. And I do think a lot of clients have that misnomer: rates come down and you're going to start to see an immediate move in the mortgage rates. And obviously it doesn't work like that.
Same thing for credit card rates or any type of structured rate program.
Right, exactly. And obviously a derivative of the Federal Reserve, they obviously have the two mandates, right? The employment side and the inflation. And we have CPI yesterday, PPI today. Kind of what's some thoughts right now on inflation? Do you think it's been subdued? Obviously, we haven't seen the impact yet of tariffs. Will that show up? And then obviously with oil prices kind of heading north, do you anticipate inflation getting a little bit higher here? And then what parts of the economy are you seeing that they're showing some signs of inflationary pressures?
Okay, so in the first go around with Trump and the tariffs, as I mentioned, there was no impact on core inflation or goods inflation or services inflation. There was no impact. What caused it actually was COVID, was the surge in the money supply, that sort of thing. So what we have seen so far from that point, from COVID until now, is core inflation to come down by about 60%. The last trade is about 2.7%. The Fed's target is 2, which is basically a made up number, by the way. But so the direction of travel has been right. Now introduce this new tariff program. What should we reasonably expect? Well, we've kind of walked through this already, but it's going to be a little bit of a tax. Some prices will go up. We do think that core inflation, which last trade is 2.7 using the PCE data, is likely to be biased up probably somewhere north of 3 here in the back half of this year. In the CPI report yesterday, under the hood, if I took some time to look at that this morning, we did see some of the tariff impact, and our expectations are that will be centered around what we refer to as core goods. So you can think of that as clothing, furniture, anything that's textile, any consumer durable product, maybe like a washing machine or a fridge, perhaps a car. We did see some of that in the report, and some of those categories had big percentage step ups. That's definitely tariff related. So I think that's probably the first inning of what we're likely to see here in the next 6 months or so. And so prepare the ship for a biased up. It's really just a one-time price adjustment, really, right? Yeah. That's the way we're thinking about it, and then it should pass. Second part of your question was repeat it, Dave. It's about the economy, parts of the economy.
Yeah, are you seeing any parts of the economy potentially maybe seeing some more inflationary pressures, given whether it's oil related or tariff related?
Okay. So not so much oil related. Remember that the Fed looks at what they refer to as core inflation, which excludes food and energy. But the oil price will eventually bleed through to the core inflation calculation in things like transportation costs, right? So in the packaging that fruits and vegetables go, or anything that we buy goes, oil prices and chemical prices are embedded in there, right? The transporting of it, the actual driving of it, price of oil up, price of gas up, etc. We've really seen oil come down and gas prices come down here this year, and so we really haven't seen the impact of that yet. I don't know that we're going to, right? I don't think there's any real pressure on the price of oil either way, right? There's greater supply in the U.S. There's greater production from OPEC plus. The economy's slowing. That usually leads to lower end demand. That would all argue that oil prices are biased down, not up. And then the final thing would be, the biggest component of core inflation is not what people think. People think go right to food and gas prices because we use those every day, right? Which is logical. The biggest component of core inflation is what's referred to as the shelter category. That's about a third of it. That's really measuring rents in real time. So new tenant rents, lodging away from home, and a crazy category called owner's equivalent rent, which is the rent you could get for your house in theory if you owned it. That's the biggest bucket. That big bucket is tied to the housing prices, which are not in the calculation. So housing prices seem like, at least in some parts of the country, California, Texas, Florida, are starting to moderate. As housing prices come down, rental prices with a lag, about a 14-month lag, will also come down. And so I think the tariff thing here is likely to cause a little bit of a push up in the next couple of months, but the broader forces, knock on wood, seem to be heading in the right direction, even though the headlines and what you read in the media don't portray that, but the facts do say that.
Right, exactly. No, that's a great point. And obviously, it sounds like you think that inflationary pressure could be short term. Obviously, most of the hard data that we've talked about so far has been pretty solid. I mean, is there anything that is causing any caution for you that might be kind of recessionary over the 12 months, or do you still think that we might be able to sidestep a recession here?
We've never been in the recession camp. And so if you think about, I don't know, 2022 to basically every year since, the Wall Street experts and economists have been calling for an imminent recession. I mean, the alarm bells and the calls for that couldn't have been any louder in March and April. Imminent recession, stock market's going to get killed, it's going to struggle for a couple of years. Not true, right? So I would encourage your clients to talk to you guys and not react to everything that's read in the media or the headlines. No, we don't see any threat of recession. We didn't coming into the year. We didn't at the lows in April. We don't now. I mean, we've got full employment. The employment picture actually just got stronger, meaning more people employed here recently. The PPI data that you referenced this morning was weaker. That's good for wholesale inflation that gets passed on to us. So no real worry about a recession, Dave. Economy's slowing a little bit, I think, just because companies have hit the pause button on CapEx. They've hit the pause button on hiring as they wait for the final tariff rules to be known, and then they can make adjustments, but no threat of recession.
Right. No, that makes sense. And probably last broader question before we get into the equity side of things. But do you think the new tax bill, right, the big beautiful bill, you think that could add any kind of rocket fuel to the economy, or do you kind of view it as kind of a non-starter and it's good to have, but it's not going to add anything to the economy?
Yeah, I'm a little from Missouri on it, but here's what I would say. Number one is through the lens of supporting consumer spending, which drives the economy. It was a darn good thing that the TCJA got extended. Now it's very expensive, right? But had that bill failed and tax rates adjusted up, that would have been bad news for mostly for middle income earners. That's where the biggest brunt would have been felt. So it passed. So that was taken off the table. That's good news for spending, good news for the economy. As far as rocket fuel for the stock market, not really. I mean, the one part of it that is accretive is the immediate expensing of R&D and depreciation, which depreciation is a non-cash expense anyway. But what that really means is for companies that want to come and build plants and increase their manufacturing scope here in the U.S., they'll be able to expense all the costs of that right up front. And so the out years return on invested capital or return on equity should look really good. And of course, that incentivizes also job creation in the U.S., which would be another tailwind for the economy. So I think those things are good through the economic lens, and they'll impact companies differently. So if you think about industries, the biggest benefactors from the expensing of R&D and capex would be pharma and medical, right, for the R&D side. Large tech, they are the spender of capex in the U.S. by far and away. They should be a tailwind there. And we've already had a host of companies say they want to come and increase their manufacturing footprint here, whether that's NVIDIA and Intel US-based companies or Taiwan Semi and Foxconn based overseas. Same with some of the big auto players. All of it in the stew, I think, is a net positive, but I don't know that it's a massive needle mover in the near term.
No, that makes sense. And now, if we kind of just look at the equity side of the equation right now, from the market standpoint, right? Obviously, we're back to all-time highs. Nasdaq and S&P are both kind of up 25% plus from their lows. It looks like we're obviously back into a bull market. Any concerns there? A lot of the questions that we're getting from clients is around kind of this AI boom and this new cycle of innovation, right? And is this kind of people, obviously a lot of our clients were around for the dot-com bubble, right? Is there any kind of analog that you see similar to the dot-com bubble, or do you think this is going to be some type of new innovation cycle and really could propel us to the next highs?
Yeah, apples and oranges. I was running about 5 billion through the dot-com bubble, and if you compare the quality of the companies today that are kind of leading the charge, NVIDIA, I guess, probably be one of the poster childs, right?
Yeah.
But if you compare a company like NVIDIA to someone like Cisco, right, which was, or Nortel or Lucent, which aren't around anymore, or JDS Uniphase that isn't around anymore, from the dot-com era, it's night and day. The quality of companies here today, their earnings power is phenomenal. Their margin profile is outstanding. But I think most important, their free cash flow generation, in the case of NVIDIA, as an example, has gone from 4 to 10 to 40 to 60 billion in free cash flow a year. You can't manufacture free cash flow. So I don't think it's a compare from that perspective through the lens of valuation. It is also not even a compare. Go back to 2000, the S&P was trading about 30 times earnings. It's elevated today at 24, which I think I'll talk about in a second. The individual company multiples are nowhere close to where they were. NVIDIA's mid 30 handle multiple. Cisco was over 100. So I don't think it's a compare. I think the only compare could be in time periods, the vertical nature of stock price movement, right? And it gets you feeling a little bubblicious from time to time, but the fundamentals and the valuation don't substantiate that. I think if there's something to think about here as an investor, it is the notion that, as you just laid out, Dave, that the tape just ripped from the lows in April. The S&P's up 30%, Nasdaq's up 40%, Bitcoin's up 50%. The multiple on the S&P just went from 17 in April, which is in line with the long-term median forward multiple, to 24 times now. So that's 7 turns above the historic median. 24 times earnings is a big number.
Right.
It doesn't mean that there's an imminent problem. And you can even argue that the quality of the companies here today necessitates and warrants a higher multiple, which I subscribe to. 24 is still a big number. So you just got 3 years of return in 3 months. And so at the index level, I think the lion's share of the move is over with here.
No, that makes sense. And if we kind of just zoom in on that for a second, I mean, do you think this benefits kind of unbundling, call it a little bit, from the kind of the packaged ETF thing, where you kind of maybe either going into direct indexing for some tax loss harvesting, or active management for individual stock picking, and maybe even a further step than that? I mean, there's certain sectors that when you go down the pro and con ledger, kind of view more favorably on the pro side of things.
Yeah, absolutely. I think so. Very quietly for the last 12 months, so if we take it back to last July to this July, there's an interesting dynamic under the surface that many people are not aware of, because Mag 7 guys get all the headlines, right?
Right.
Those Mag 7 companies have driven all the earnings growth and all the return for the last 5 years, and it's been warranted. Now the playbook looks a little different. Earnings power is much more broad, and so the cyclical and value components have much better earnings power than they've had in the last couple of years. Small and mid-cap stocks, same thing. Yep. Foreign equity markets, Europe, emerging markets at all, have better forward earnings power than they've had in the last 15 years. And so that's why those markets, it's one of the reasons anyway, those markets have done better. So to answer your question, I would say yes. If you go under the surface of the S&P 500, the index that we all know, there's opportunity under the surface. And I think what you need to think about is coming down in market cap range. Make sure you have some exposure there. Make sure you have some exposure overseas. And, let's face it, foreign returns have been a major anchor on client portfolios for almost 2 decades. And that's changed here in the first 6 months. We think that has legs probably for the next couple of years. And so I'd make sure you have some exposure there. But it really, I think at this point, especially in light of the tariffs, will come down to idiosyncratic risk, meaning stock selection, the ability to sift through a host of names and pick the companies that you think have the ability to compound earnings growth by double digits on a go-forward basis. And there are plenty of those names. Might not be the names people know, but there are plenty of them. Yeah.
Right. Absolutely. There's always opportunities out there, whether it's a bull market or bear market.
Right.
And if we just double click on you briefly hit on international, it sounds like you see opportunity there. I'm sure a lot of it has been because of the weakening of the US dollar, right? And that, but is there specific regions or sectors internationally that you guys view with kind of a favorable risk profile right now?
Yeah. So we like Europe. You're right. Part of it is the weakening dollar. So everybody knows returns in local currency, when translated into the US dollar, and the US dollar is weaker relative to the home currency, that amplifies the return. And so somewhere around 55% of European returns translated into dollars for your clients, about half of the return is because of the weakness in the US dollar. That's probably largely run its course. However, for the first time in 15 years, forward earnings growth for 25 and 2026 is actually better in EM, better in Europe than it is in the United States. So we haven't seen that in almost 20 years. And that's the underpinning, I think, for the move. It's been amplified by the currency dynamic, no question, but the earnings growth there looks pretty good. And what we've heard for the last 15 years is, David, you need to own Europe and EM because they're cheap. Well, they were cheap for a reason, because there was no earnings growth, and those markets did nothing because of that. Now you've got the catalyst with the backdrop of much more favorable valuation relative to the US, and that's why those markets are performing well.
No, absolutely. And I think it's the first time in a while we're actually, we're not overweight, but we're market weight right now on the international side. And I think it makes sense, and that trend should probably continue. So it makes a lot of sense, Chris. Shifting gears a little bit now to fixed income, you obviously shared, I think, where you think the optimal spot is on the yield curve. So we're not going to belabor that, but maybe just kind of talk about, are you favoring anything around tax-free munis versus high yield versus short-term treasuries, in terms of just the different asset classes right now in terms of the fixed income markets?
Okay, so let's walk through that. So you're right. We did highlight shorter duration fixed income mandates, where I think the yield capture, and honestly, Dave, I think that fixed income on the taxable side is much more a coupon clipping exercise than anything else. I don't think we should expect large movements in rates, which have a huge impact on bond fund returns. And so with that said, if we're right on that, and we have been in the first 6 months, I think it's likely to continue, then it becomes a coupon clipping exercise, really, because rate movements are unlikely to make an impact. Credit spreads, it's kind of in the weeds, but in investment grade space and high yield space, credit spreads, or the risk of default, are essentially at 10-year tights right now, right?
Yeah.
So that tailwind to total return is not really present either. And so then we default to whatever the coupons are. So you've got it in the short duration space. You also have it in high yield taxable space, where all-in yields are somewhere mid-7 handle. We're not worried about recession, as we spoke to earlier. The credit quality there is excellent. The duration risk is about 3 years, meaning it's not going to be that sensitive to the movement in interest rates. And so we're bullish there. Also a good, very strong risk-adjusted returns over time in that space. And then the final piece would be in muni bonds, right? Which we get a ton of questions here. They've not performed well in the last couple of years. Last I checked, they might even be down on the year here, really impacted by the market turbulence in March and April, and even into May, where higher levels of volatility impacted the muni space. We love the taxable equivalent yields that munis offer for high tax bracket investors,
Right.
But also, and I don't think this gets enough airtime, the diversification benefit for muni bonds within a bond portfolio, pretty meaningful, with the exception of investment grade corporate bonds.
Absolutely.
Because they have a similar duration match. It's valuable. So I know it hasn't really worked. We like the fundamentals there. We're buyers there.
No, it makes sense. I completely agree with you, and we've obviously been kind of positioned that for our clients as well. So I think we hit on the fixed income side, obviously in the beginning, and just now kind of moving over to that third and last sleeve of clients' portfolios, which I feel like is getting a lot more attention as we've been the last couple of years, right? Is the alternative sleeves, and that could mean broadly a lot of different things, right? But really, when clients now that maybe have not had a big position in alternatives or maybe no alternatives at all. I mean, let's start high level, right? I mean, how do you kind of determine the appropriate kind of allocation weighting to start building into alternatives, and what are some of the pros and cons that investors should be kind of worried and concerned about and think about when they're allocating to the alternative space, and then we can drill down from there.
Okay, so alternatives, our view would be alternatives have a place in client portfolios, and that we should think about morphing from the traditional 60-40 to something like, I don't know, 60-20-20 or some variation of that.
Yep.
Right, so the pros, an alternative investment generally, it can be a lot of things, as you alluded to. The way we think about it are getting exposure to private pools of money, private pools of risk, right? Risk return. It can be things like private equity, so ownership stakes in companies that are not public. And these days, I feel like there are fewer companies coming public, right? And the better quality companies are staying private. So private equity would be one. Private real estate would be another, right? So you can find very bullish arguments in some sections of commercial real estate. Maybe not the office plays, but warehouses and that sort of thing, specific to industry. Yeah. We think there's a lot of opportunity there. Private debt, sometimes called direct lending, the ability to step in to the void that used to be filled mostly by regional banks that have kind of pulled back from the space because of their CRE exposure, also creates opportunity. And so for clients that haven't had any exposure there, one of the pros is getting access to that sort of return stream that are widely used by institutions all over the world, right? Widely used. And individuals probably won't use it to the size and scope that university endowments will, because they have perpetual, right, time frame, multi-100-year time frames. But the other pro is they may insulate you from your own emotion, i.e. you go through a period like April, and you look at your equity portfolio and go, oh my God, and you call Dave and say, what are we doing? But private investments are marked to market, maybe quarterly or semi-annually, but they're not marked to market every minute and every day, right? So you can capture good risk-adjusted returns there, and there's a lot of cons to it. A lot of pros to it. Sorry, right. The con would be making sure you understand what your ability is to get your capital back, right? And there's various structures around that.
Right. No, no, absolutely. I mean, I think you hit the nail on the head. I mean, there's obviously that behavioral piece to all clients, right? And obviously they get freaked out, especially with on April 2nd, or like Liberation Day, and that could kind of keep them in this seat a little bit longer, which is obviously a positive thing. And you kind of hit on the certain asset classes in private real estate. I mean, do you guys have any views as you drill down in the alternative space, whether it's private credit, private real estate, private equity, venture capital, anything that even cryptocurrency? I mean, that's kind of viewed as an alternative. Anything that you guys view as kind of maybe for the next, call it 18 plus months, a more favorable asset class?
So we've been bullish and maintained bullish posture on private equity, but the secondary version of that.
Okay.
Right. Bullish on private real estate and bullish on direct lending as well.
Yeah.
Franklin Templeton is an organization. So Franklin Templeton, incidentally, is one of the top 10 players in the world in alternatives. Most people might not be aware of that. We are also very involved and built up around blockchain and Bitcoin as an asset class as well. You can certainly put that in the alternative bucket. We can make a mathematical case for not just including privates like traditional privates we just discussed, but we're using something like Bitcoin in a client portfolio, depending on their risk and return objectives and their profile. A little sliver there also will improve the efficient frontier, meaning maximizing return at a certain risk point in client accounts. So it's obviously going to depend on each situation, but all of those tools are now in the toolkit and available generally, and warrant due diligence. There's no question.
Absolutely. I completely agree. And obviously, ending this segment with kind of risk management, right? And that, like you said, I mean, that 60-20-20 portfolio could kind of lower the correlation, smooth out returns and things. Now with clients kind of already back to all-time highs, obviously it was a very severe and nervousness during the drawdown, but like I said, we're back to all-time highs. Any kind of approach or anything to managing drawdowns going forward without missing some of the upside, or any kind of advice for clients right now that have maybe been a little spooked out with the administration, but now portfolios are back to all-time highs in terms of risk mitigation right now?
Okay, so one of the determinants to long-term investing success is mitigating risk, or making sure you understand the risk, and making sure that the risks that are present in the portfolio are actually the risks that you want exposure to. There are a lot of ways to decompose that, and we could do a 2-hour conversation on that alone.
Right.
I think the lesson coming out of the sell-off in March and into the lows in April 7th is that if clients have worked with their advisor and built a long-term plan, you've worked on it together, you've been honest about your objectives and your tolerance for risk, i.e. standard deviation and volatility, and you weathered that storm. That's right. And you've weathered other storms, GFC, COVID, 1998 long-term capital, tech bubble. You've weathered all of it. What we know for sure is proven by history is that the stock market always recovers. It might take some time. This time was the fastest move we've ever seen in history, from a 20% sell-off to a new all-time high. So it's a little bit abnormal. You got 3 years of return in 3 months there. But sticking with the long-term plan, I think, is the message that I want to give. And unless something has changed in the plan and you need to communicate that with your advisor, then try not to get caught up in the headlines. The stock market really doesn't care about politics. It might in the short term, but over a 100-year period or a 50-year period or a 25-year period, the stock market is highly correlated to the growth in corporate earnings. That is the prime driver. That is really the only variable that counts. So when you think about all the things you see and hear, the question you should really ask yourself is, how is this likely to impact forward earnings power? Now, that's coming from an equity guy, right? That's how I think.
Right.
But that's really what's important. Israel and Iran is a good example, right? A lot of concerns there. World War III being battered around. We never thought that was really going to happen. But the question I had to ask myself was, what's the likely impact on earnings? And I didn't think there really was one. Turns out, thank God, there wasn't. But stocks follow earnings over time. Stick with your plan over time. That works.
You're spot on. We tell that clients it begins and ends with the plan, right? And
Yeah.
during the drawdown, if your income didn't change, your spending didn't change, if this doesn't change your plan at all, you really have nothing to worry about. Especially if you have 5, 10, 15 years to retirement, right? And obviously if things were going to change in your plan, we should have been adjusting it before, right? But everything starts and ends with the financial plan.
Yeah.
Yeah, I think you hit the nail on the head. And one closing question we always like to kind of ask the strategist as we round things out, right? Obviously, we talked a lot about the pros and things in the market, right? But if you could kind of maybe highlight maybe one contrarian view, could be a pro or a con, or maybe some underappreciated risk. Maybe the market's discounting right now. People might not be thinking about as we enter the second half of 2025. Is there anything that you would kind of highlight or pinpoint for our clients?
I think I'm going to sidestep the geopolitical questions or concerns.
Yeah.
Because those are omnipresent. They've been that way through my entire career. They'll be that way through everybody's experience. There's not much we can really do about that. In terms of things that could go wrong here, if we think about the stock market present valuation at 24 times earnings, which, as I mentioned, it's a big number. It's expensive. I think the one risk, there's two primary risks. Number one is the impact of tariffs on corporate earnings, which is the most important thing. What will we see here on a go-forward basis? We really haven't seen much, but the companies who have warned about it, big tech company warned about it this morning, the stock's getting killed. Lululemon, a name that everybody knows, a month ago, did the same thing, stock got killed. We're going to see more of that. And so if that seemingly is any sort of contagion, I don't think it's going to be. That is a risk. The other risk would be that the Fed overstays and doesn't lower rates at some point, right? So recessions are caused by Fed policy generally, right? Unless we have something like 9/11 or the GFC, right?
Yeah.
Which hopefully are 100-year floods. They're probably too tight right now. Our thought is inflation is a one-time thing and not a persistent problem. If they have a different view and keep rates higher for longer, that could pose a potential issue. Or if inflation does spike a little bit and we're wrong, it's not a minor issue, but it's a major issue, and they raise rates, the stock market is not ready for that.
Absolutely. I mean, I think you hit the nail on the head. I mean, it kind of right now is a lot of weight right now is in Jerome Powell's shoes. And
Yeah.
we'll see what they do. Obviously, they have a meeting here in July, and then obviously as we get close to September, we'll see what they do. But we could not thank you enough for your time today. Your insights were invaluable, right? I mean, your perspective on the macro landscape, kind of inflation dynamics, Fed policy, the market structure, especially as we're trying to guide our clients through what's shaping up to be another unprecedented year. A lot of unknowns as we enter the second half of the year. And obviously our clients know, but at GatePass, we're subscribers that thoughtful long-term investing is really shifting through a lot of this short-term noise headlines, sticking to your plan. It's really about having the right context, being disciplined, and having the right partners in your corner, right? I mean, that's why we do these GatePass market pulses, right? We bring in third-party specialists that focus on this, like you at a $1.5 trillion firm, you live, sleep, eat this, right? And so it's great to help our clients really tune out some of the chaos and focus on what actually matters. So to everybody, just wanted to say thank you for your trust and your time. If you have any follow-up questions, please reach out to any of your advisors here at GatePass. If you want to dive deeper in anything, you have any follow-up questions, don't hesitate to reach out to us. And we'll obviously continue to bring you these on a semi-annual basis with people that really shape our investment thoughts, right? And where we get a lot of our thoughts and information from. And we look forward to seeing you at the next GatePass Market Pulse. But until then, stay invested and stay disciplined. Take care, everyone. Thanks.